So now we can proceed with the topic. We are discussing on ratio analysis, and we looked at various categories of ratios. That was what I was doing here in our last session. We see that ratios are classified into 5. One was the valuation stroke investors ratio. Number 2 was the liquidity ratio. The liquidity ratio. Number 3 was the gearing stroke leverage ratios. And then number 4, we have is profitability ratios. And then lastly, number 5, we have the activity or the efficiency or turnover, also known as asset utilization. Utilization ratio. Now, we said that valuation ratio, they are ratios used to determine the value of the company. Liquidity ratio, they are ratios used to determine how the company can be able to afford to pay the short-term obligation when they fall due. And we say that they are evaluated using ratios such as the current ratio, quick ratio, which was there on. Then there was gearing ratio. Now, gearing ratio, on the other hand, they are ratios which are used to determine how the company has financed its investment or assets using the borrowed fund. Then we have profitability ratio. Now, we have to start with profitability ratio. So, number 4, we have it profitability ratio. That's why we have to start with the old ratio. Profitability ratio. Right, you see that? There are ratios. There are ratios which indicate the ability of the company. There are ratios which are used to determine the ability of the company, or ratios which are used to determine the ability of the company to generate returns, the ability of the company to generate returns, the ability of the company to generate returns, the ability of the company to generate returns in relation to sales, in relation to sales and investment, in relation to sales and investment, in relation to sales and investment. Full stop. Then what is that? They are classified into 2. 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 Number A, profitability. Number A, we have its profitability. Profitability in relation to sales. A is profitability in relation to sales. And number B, profitability in relation to investment. Profitability in relation to investments. Profitability in relation to investments. Now let's start with the first one. A. Profitability in relation to sales. Profitability in relation to sales. Profitability in relation to sales. You see that? They include number 1. So now you're looking at the profitability in relation to sales. Number 1 is the gross profit margin. Number 1 is the gross profit margin. Yeah, so how do you get the gross profit margin? So you take the gross profit, you divide by the sales, you multiply by 100%. Number 2 is the operating profit. Operating profit margin. Operating profit margin. So how do you get the operating profit margin? So you take the operating profit, of which operating profit is the same as the earnings before interest and tax. Then you divide by the sales times 100%. Number 3 we have is net profit margin. And for the net profit margin, you take the net profit. Yeah, that's equivalent to the profit after tax. You divide by the sales. You multiply by 100%. The one is operating expense ratio. Operating expense ratio. So how do you get the operating expense ratio? So you take the total expenses, you minus the interest expense, or which you divide by the sales times 100%. Number B. So that was the profitability in relation to the sales. Now, you can see the similarities that all the ratios to the profitability in relation to sales, the denominator is the sales, and then all of them they expressed in percentage. Number B, profitability in relation to investments. Profitability in relation to investments. In relation to investments. Profitability in relation to investment. Like to say that these ratios include, these ratios include, these ratios include, these ratios include. Number A, or number one, return on investment. Return on investment, also known as return on total assets. Return on total assets. So how do we get the return on investment? So to get the return on investment, you take the net profit or the profit after tax. So this is the net profit from a project. Then you divide by the total assets times 100%. Number 2 is return on equity. Return on equity. Also return on net worth. On return on net worth. So how do you determine that? So to get the return on equity, you will take the profit after tax, you divide by the equity times 100%. Times 100%. You can explain, you say that equity elements include, equity elements includes semicolon, ordinary share capital, comma, share premium, retained earnings, retained earnings, retained earnings, and reserves, and reserves, and reserves, and reserves. Yeah, that's what makes up the equity. That, in short, that's the ordinary shareholders. Well, the ordinary share capital, we have the preference. So not the preferential. Preferential is not part of the equity. We have the ordinary share capital, we have the share premium, we have the retained earnings, and then we have reserves such as liberation reserve. Good. Number 3, we have return on net assets. Return on net asset, also known as return on capital employed. Return on capital employed. Now they get that. So return on capital employed, you'll take the profit after tax or the net profit. Then you divide by the net assets or the capital employed times 100%. And how do you get the net assets? Now, net asset is equivalent to the total assets minus the current liabilities. Good. So that's all about the profitability issue in relation to sales and then in relation to the investment. Now, in relation to sales, that one affects the items in the income statement, and that one is on the statement of financial position. And then that was number 4, profitability issues. Now we look at the last ratio, the last category of ratio. That is activity ratios. They are called activity ratios or efficiency, or the turnover ratios, or asset utilization. Asset utilization ratios. Correct, is that? They are ratios, which indicates the efficiency with which, which indicates the efficiency with which the company utilizes its assets. The company utilizes its assets. The company utilizes its assets in order to generate revenue. They include number one, inventory stock turnover. Number 1 is the inventory stock. Inventory is the same as stock turnover. Right, to say that? This indicates the frequency in which the frequency in which stock is converted, the frequency in which stock is converted into cash. Stock is converted into cash. Stock is converted into cash. First of all, it's calculated as follows. It's calculated as follows. It's calculated as follows. The cost of sales divided by the average stock. Cost of sales you divide by the average stock. And how do you determine the average stock? To determine the average stock, we'll take the opening stock. Then you add the closing stock. Then you divide by 2. Opening stock plus closing stock, then you get the average. Then I can see that. You see that? When opening stock is not provided, when opening stock is not provided, when the opening stock is not provided, when the opening stock is not provided, comma, closing stock, closing stock, closing stock is assumed to be the average stock. Closing stock is assumed, closing stock is assumed to be the average stock. When opening stock is not provided, closing stock is assumed to be the average stock. But that can also happen with the data set. Now, whenever you're told to compute the average data, so you also take the opening balance plus the closing balance, you divide by 2. But whenever you're not given the opening balance, the closing balance will be assumed to be the average. Number 2, debtors stroke receivables turnover. The debtors stroke receivables turnover. Yeah, what are these varieties? This indicates the frequency. This indicates the frequency. This indicates the frequency with which customer buys goods on credit. With which customer buys goods. With which customer buys goods on credit. With which customer buys goods on credit. Is calculated as follows. It's calculated as follows. It's calculated as follows. So how do you get the data for the receivable turnover? So what gives rise to data is the credit sales. So therefore, you take credit sales, you divide by the average debtors. You divide by the average debtors. And now the concept of computing the average is the same. That means for you to get the average data, you'll take the opening debtors plus the closing data, you divide by 2. But if you're not provided the opening debtors, the closing debtors will assume to be the average. Number 3, another ratio. Creditors are stroke payables turnover. Creditors, they are also known as the payables. So that is that. This indicates the frequency with which this indicates the frequency with which this indicates the frequency with which the company buys goods on credit. The company buys goods on credit. The company buys goods. The company buys goods on credit. Yeah, so it's calculated as follows. It's calculated as follows. Calculated as follows. Now, what gives rise to the credit of the payable is when the company buys goods on credit. So that means you'll take the credit purchases, you divide by the average creditors. Number four, we have fixed asset turnover. Fixed assets turnover is when you take sales over fixed assets. Number five, we have is the total assets turnover. So to get the total assets turnover, you take the sales, you divide by the total assets. Divide by the total assets. Number six, look at the stock holding period. Stock holding period. Now, ordering by stock holding period, so that this indicates the number of days, this indicates the number of days, this indicates the number of days stock is held, the number of days stock is held in the store, stock is held in the store before they are sold, before they are sold, before they are sold, before they are sold. Yeah, so for example, that means that, for example, if you are dealing with some inventory you're selling, so when you buy them, so how long does it take before you sell them? So the average period, that's what we call now the stock holding period. You have to say that it's computed as follows. It's computed as follows. It's computed as follows. It's computed as follows. So the number of days in a year, of days in a year, you divide by the stock turnover. Stock turnover. Or alternatively, you can take the number of days in a year, of which you take 365 days, you multiply by the average stock, then you divide by the cost of sales. Number seven is the debtors correction period. This is the number of days. This is the number of days. This is the number of days. Number of days. Which credit customer, which credit customer, which credit customer takes before payment, which credit customer takes before they pay. Credit customer takes before they pay. It's computed as follows. It's computed as follows. That's how we determine the average data correction period. So to determine the average data correction period, you'll take the number of days in a year, you divide by the data's turnover, or you take the number of days in a year, that's 365 days, you multiply by the average data's, or which you divide by what gives rise to data are the credit sales. You divide by the credit sales. Number 8. Number 8 is the creditor's payment period. It is that. And this indicates the average number of days. This indicates the average number of days. This indicates the average number of days. The average number of days with which the company, with which the companies pay their creditors, stroke suppliers, stroke suppliers. But that means when a company buys some credit, how long do they take before they pay their suppliers? So how do you determine that? So that is computed as follows. It's computed as follows. So you take the number of days in a year, and then you divide it by the creditors turnover, or you take the number of days in a year, of which you take 365 days, you multiply by the average creditors, or of it, you divide by what gives rise to creditors, by the credit purchases. Credit purchases. Yes. So now I'll do some illustration. Open May 2017, question 4A. May 2017, question 4A. So now I read the question. The following are the summarized financial statement of for Basa Limited. So we are given Basa Limited statement of financial position as at that 1st of December. We have both for 2015 and 2016. Then we also have the Basa Limited income statement for the year ended also that 1st December 2015 and 2016. Then we have notes. And note number 1, we that retained profit brought forward, so given for each year. Also, we have the dividend paid during the year. Required. For each of the 2 years, calculate number 1 is the earnings per share. So for each of the 2 years, earnings per share. So how do we get the earnings per share? Now, earnings per share, it's part of the valuation of the investors' ratio. So we have 2 years here. We have 2015. We have 2016. Kindly don't copy. I'll give you time to copy. First of all, reason, understand. Once you understand, I'll give you time to copy. So number 1, we are to determine the earnings per share. So how do you get the earnings per share? So that to get the earnings per share, you take the total earnings attributable to the ordinary shareholders, which is equivalent to the profit after tax. But in case they have the preference shares, you deduct the preference dividends. But in this case, there is no preference dividend. So with profit after tax, you raise the preference dividend so that you get what we call the earnings attributable to ordinary shareholders. But since in this case we don't have the difference business, we just take the profit after tax, then we divide by the number of shares, number of ordinary shares. So to get the profit after tax, we have the income statement. And the income statement, we have the profit for the year 2015 was an amount of 9520. Then 2016 was an amount of 11660. Then we divide by the number of ordinary shares. So how many shares do we have? How many shares do we have? So to get the number of shares, let's go to the equity. Let's go to the equity. Under the equity, we have held up share capital of 0.25 shillings per share. That's what we call the par value. So in this case, we're not given the number of shares, but this will get the number of shares. So to get the number of shares, number of ordinary shares, you'll take the equity or the ordinary share capital, you divide by the par value. You divide by the par value. And if you look at the two financial years, the equity capital is the same. So therefore, we'll take the ordinary share capital, we have it 9920 made up of shares of 0.25. We divide by 0.25. So that means if the par value is 0.25, how many shares do we have? That 96? 650. 680, yeah? Good. So therefore, divide by the number of shares. So the number of shares we have is that 9680. That 9680. So given into two decimal places, the mostly for the ratios they are expressed into two decimal places. 0.24. Zero point 29. Good. And number two. Number two, to determine the dividend cover. So how do we get this? Now, we said that dividend cover, it shows the number of times through which you can pay the dividends from the available earnings. Therefore, to get the dividend cover, you take the earnings per share, you divide by the dividend per share. We already have the earnings per share, that's what we have computed in number one, which is 0.24. There you have 0.29. And then you divide by the dividend per share. So in this case, you're not given dividend per share, but you can be able to compute the dividend per share. So how do we get the dividend per share? So to get the dividend per share, you take the total dividend declared and paid, then you divide by the number of ordinary shares. That's how you get the dividend per share. So we have for 2015, we also need to compute for 2016. So you're given the dividends. Now let's go to the next. Note number 2, we have the dividend paid during the year. So 2015, they paid dividend of 22.40, and then 2016, they paid dividend of 24. Then you divide by the number of ordinary shares. So you already have the number of shares. Each year we had was about 9680, about 9680. Move into two decimal places. 0.0706. So where we divide the earnings per share divided by the dividend per share, which is 0.06, also 0.06. You get 4 times. 4.8. Yeah, remember say that BC shows the number of times through which the dividend can be paid from the available earnings. Number three. Number three, we want the current ratio. Now, current ratio is under the liquidity ratios. So, how do we get the current ratio? Now, current ratio is one of the simplest formula. Is current asset minus the current liability. And you see that the recommended ratio is So you see that the recommended ratio is 2:1 or 2 times. That means the current asset should be at least twice as the current liability. So we'll take the current asset. So what do we have to the current assets? So current assets here we have is 92,447. Then 2016 we have is 99,615. Then we divide into the current liability. We also have the current liability. And now the current liabilities we have is 36,862. Where we have is 42,475. Give me that. Two point 2.5. 2.51 times or 2.5 is 1. 2016. Sorry? 2.35 times or 2.35 is to 1. So that means in terms of liquidity, see the recommended ratio is 2 times. Now 2015, it was 2.5. So that means the current asset is 2.5 times of the current liability. So in terms of the liquidity, the company performance is okay. Also, if you look at this here, it's 2.35, which is above 2:1 or 2 times. So that means in terms of liquidity, the company has been able to maintain the liquidity for the 2 years. Number four. Asset test ratio is also part of the current, liquidity ratios. And how do you get the quick ratio? Quick ratio is also known as acid test. And you see that this ratio shows the ability of the company to pay its current liability from the most liquid assets. And how do you get the most liquid asset? So therefore, we'll take the current asset, but you eliminate the inventory. Because sometimes it's difficult to convert inventory into cash within a short period, as opposed to the others. Then you divide by the current liability. So the current asset we have is 92,447. Here we had was 99,615. Then we eliminate the stock. So inventory for 2015 was 40,145. Here we have is 50,455. Then we divide by the current liability. 2015 we have the current liability, which was 36,862. Here we have it 42,475. What do you get? Five point 1.42 times is to 1.16 is to 1. And lastly, number five. Return on capital employed. So how do we get those? Now, return on capital employed, this is a profitability in relation to investments, where we take returns, which is the profit after tax, divided by the net assets. And all the profitability ratio are expressed in percentage. So we take the profit after tax, which is the same as the profit for the year, and that one we get it from the income statement. Let's go to the income statement. From the income statement, we have the profit for the year. Here was 95.20. Here was an amount of 11,660. Then we divide by the net assets. So also in the question, we are given the net assets. And this is the net assets. 2015 was an amount of 40,740. And also here was an amount, is it 50,000? 50,000 times 100%. Times 100%. 23.36%. What about in 2016? Sorry? 23.32. 23.3. So now you can copy. You can copy. Everyone have illustration? May 2019, question grade B. Yes? Uh-huh. 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 Is differing, eh? Yeah, we say that. How do you get the net assets? Is the total asset minus current? Do it right together. Now, the one I have used, I have not used any formula. I have used what you have been given. Go back to the question. I have not compared the net asset. In the question, they have given us the net asset. That's what I have used. Have you seen that? Yes, that's what we use. But the general formula for getting the net asset is the total assets minus the current liability, or equity plus the long-term debts. But sometimes, when you talk about the long-term debts, we have sometimes, it depends with the company. If you have a loan, for example, you expect to pay within the next 1.5 years, 1.5. So sometimes they include it, or they don't capture it as part of the net asset. And that's the case they have used here. That's why in this case, they have only taken the total assets and then included the current, the total asset minus the current liability. So in this case, the debt we are having there, the company has classified it almost like current asset. Yes, it's more than 1 year, but they expect also to pay in the near future. They expect to pay within the next near future. That's why they have used it like that. But in case you're not given the net assets, just take the total assets minus the current liability. May 2019, question breathing. May 2019, question breathing. Question breathing. And I thought that the following is a summary of financial data for Hakika Limited for the financial year ended that 1st of December 2017 and that 1st of December 2018. So we have the income statement for the 2 years, where you have the earning before interest and tax. The earning before interest and tax is what we call the operating profit. And then there is interest, there is tax, earnings after interest and tax, that's the same as profit after tax. Then you have the dividends payable. And then we have the statement of financial position. So we have the shareholders fund, we have the long-term debts. Added information, number 1. The number of outstanding shares, so we are given the number of shares. Then number 2, have the price earning ratio for Hakika Limited, and then for the industry. Required. Calculate the following ratio for year 2017 and 2018. So we compute for 2 financial years. So 2018, 2017. Number 1 is the return on capital employed. So how do you get those? Don't confirm from your notes. Don't confirm from your notes. Actually, the last thing, just wrap it here. And actually, I've asked you a question. How do you get those? A return on capital employed. Sorry? Profit for the year, that's very correct. For the profit after tax, you divide by the net asset, correct? So you take the profit after tax you divide by the net asset. So we have the profit after tax. Yes. So the profit after tax for 2018, we have the earnings after interest and tax, which is 17,698. Don't deduct the dividend. If you deduct the dividend, what you get is what we call the retained earnings altogether. And retained earnings is part of reserve. So you take the profit after tax. So it's 17,698. Here you have it an amount of 15,834. Then you divide by the net asset. How do you get the net asset? This is the current asset. Total asset minus current? Or, okay, it's very simple. Hata kama siku mpe wengine. If you take total asset minus current liability, it has to balance, right? What do you mean with equity? Okay, this is what I mean. To the balance sheet, we have non-current asset, we have the current asset, so that we get the total asset, which must balance with equity and liability. So for the equity and liability, we have equity, then we have non-current liability, and we have the current. So to get the net asset, we assume that we take the total assets minus the current. So therefore, also net assets, we said it's also known as what? Capital employed. Are you together? And how do you employ the capital? Equity, you borrow to finance the project. Are you together? So it's also the, can you go back to the next and right plan? Go back, we wrote about net assets. Are we there? But we wrote about the net assets. We wrote that net asset is the current asset, I mean the total asset minus current liability, or is the same as equity plus non-current liability. Equity plus the non-current liability. So it's the same as equity plus non-current liability. But that's what we call the capital employed. Now let's go back to the financial statement. So we're determining the return on capital employed, which is the profit after tax of a net asset. Net asset is also known as the capital employed. And then you see that all the profitability ratio are in percentage. So I've taken the profit after tax, you divide it by the net assets. How do you get the net asset? You go to the statement of financial position. In the statement of financial position, we have the shareholders fund. Now that's what we call the equity. Then we have the long-term debt. Now the total you have in your question paper, can you write it as net asset? Net asset stroke capital employed is the net asset stroke capital employed. Yeah, so that means in 2018, you'll get 107,800 times 100%. You'll take 105,174 times 100%. Now give me in percentage. So 16.42%, 42%, 15.06. Now, for example, if you remember, you see that under financial statement analysis, the key tools use the ratio analysis. And the ratio analysis is all about financial statement analysis, but used for decision making. Now, if you look at this case, 16.42%, 15.06%. What can we comment about the return on capital employed for the 2 years? That's what we call the trend analysis. You are comparing the performance of a given period. Is it increasing or reducing? It is increasing or decreasing? Ink or D? Or D, yeah, correct. Now we are increasing. Yeah, you see this 17, this is 20, 18. So the return was 15, here has increased to 16. So that we can comment that the performance of the company is increasing over time. Good. Number 2 of the question. Number two is to determine interest coverage ratio. Interest coverage ratio. Good is the interest coverage ratio. Which category of ratio? You can confirm that one from your notes. Leverage, yeah, it's part of the leverage. You see, leverage shows how the company has used debt to finance its assets. Once you borrow, what do you pay in return from maybe from a loan? So you pay the interest, Yeah, the interest cover ratio. It's also known as what? You need to know all the names because the next time the examiner will not ask about the interest coverage ratio. We'll ask another name. You know what? An interest ratio, right? Yeah, and how do you determine this? You see that this ratio, it indicates the number of times we can pay the interest from the available operating profit. And what is operating profit? Earning before interest and tax. Therefore, how do you get the interest coverage ratio? Yeah, you check the earning before interest and tax. That's what we call the operating profit. Then you divide by what? Yeah, interest expense. It shows the number of times. So how much of the operating profit or earnings before interest and tax? Yeah, so the earning before interest and tax we have was an amount of 29,498, and here we had was 27,012. Now the question is, from the operating profit, if you have to pay the interest, how many times can this operating profit cover to pay for the interest? So we divide by the interest expense. And so we have the interest expense, which was an amount of that one, 06. Here was an amount of that 726. It shows the number of times. So we want to express in percentage. 9.5 times. That means if you have to pay an interest of that 106, from the available profit, we can pay 9.5 times. What about the one? 7.25 times. Good. So you can also observe that from 7 to 9. What does that mean? Okay, now let me hear your argumentation now. You can try. Sorry? The ability of the company to pay has increased, correct? The ability of the company to pay has increased. To pay what? The debt. Well, now that's very correct. But your explanation has gone to explain the current ratio. You see, the current ratio shows the ability of the company to pay short-term obligation when they fall due. So when you say that the ability of the company to pay has increased, that shows now you're explaining the liquidity ratio, not the leverage ratio. But that's a good try. I like those who try. First, you don't have to be correct. It's based on what you're thinking. Yes, Sharon. They have reduced their debt. That's very correct. You see, in this case, what has happened? If you look at the interest, the more the interest, the lower the ratio. Are you together? The lower the interest, the higher the rate. So that means over time, we have reduced our debt. And if you reduce the debt, that's when the interest reduces. When the interest reduces, what happens? The times interest ratio increases. Yeah. Because if you, for example, take that, assume the same profit of 29,498, we pay the debt, now remaining only small debt, of which we are paying an interest of 200. We reduce the debt so that we pay an interest of only 200. So what will happen? We have reduced the debt. The interest level is only 200 from that 106. So how many times will be that? You have it? 140? You see what's happening? If you reduce the debt, that means we pay less interest. So what happens to that ratio? Okay, so from 1.5 to 140? Yeah, that means if you reduce the debt, what happens? The times coverage ratio increases. Number three. Number three, we have to determine what? The earnings per? How do you get the earnings per share? So earnings per share, you take the total profit after tax You pay any preference dividend in case there is any preference dividend. Then you divide it by the number of ordinary shares. We have the profit after tax, which is 17,698. This was 158.34. You divide by the number of shares. Do you have the number of shares? We have a room to compute. How many shares do we have in 2018? So we have to give them the number of shares. And additional information number one, the ordinary shares outstanding. So this was an amount of 28,000, also 28,000. So it's the same. So that means over the 2 years, the company has not issued any new shares. So how much of the earnings per share? You're getting 0.6? 63, 2017. 0.57. What can you see? What has happened? From 0.57 to 0.63. What has happened to earnings per share? Huh? I'm not saying you interpret it. Okay, what has happened there? We just observe what has happened there. What has happened? It has increased. Yeah, because if you look at the denominator, the company has not issued any shares, but the profitability for the two, even you can tell without computing, the profitability was 15, and the profit was 15. This was an amount of, but the number of shares remain to be the same. So in that case, that means the earnings per share over the period of time has increased. Good. So that indicates a better performance. Number 4, a dividend yield. We say that, if you remember, I'm the one who said that all the yields, their denominator is what? Now I'm trying to give you a clue on how to understand these formulas. Of which high chances you might not understand this formula. You cram them. Yeah, actually, a firm has a lot of formula. And they are very simple when you're running them. You see, for the two classes, we have only concentrated with ratios, earnings per share. Now, the next topic will have its own set of formula. The other topic, its set of formula. So you understand them when you're running. But now, if you don't practice, so you can imagine every topic with its own formula. How do you remember that? So you start revision as early as possible. That's my advice. Yeah. So dividend yields and the earnings yield, always the denominator are measured with reference to the market price per share. That means to get a dividend yield, you take the dividend per share over the market price per share. If you have to get the earnings yield, you take the earnings per share over the market price per share. Dividend per share, do you have? You don't have. How do you get the dividend per share? You take the total dividends, you divide by the number of, number of ordinary shares. 2018, 2017. From the income statement, we are given the dividends declared. So 2018, the dividend payable is an amount of 9.6 million, we declare an amount of 6.2. Then we divide by the number of ordinary shares. So the number of ordinary shares does not change. We had 28,000, 28,000. Give me 2 decimal places. 0.34, 0.34, 0.22. So therefore, the dividend per share, here we have it 0.34, there was 0.22. Then you divide by the market price per share. How much is the market price per share? Are you given the market price per share? Yes. Where is it? No, you can't see it. We are not given, right? Yes, but we have, can you go to additional information number 2? We have the price earning ratio. Yes, use the ratio to get another ratio. So how do we get the price earning ratio? Is the market price per share over the earnings per share. So we have the price earning ratio. We have earnings per share. So what we need is the market price per share. So you make it the subject. So to get the market price per share, if you make it the subject, you cross multiply. So we take the price earning ratio, then you multiply by the earnings per share. So, so how much is the price earning ratio for 2018? And remember, you are measuring the performance of the company, not of the industry. So therefore, you take the price earning ratio of Hakika Limited, not for the industry. And we have was an amount of 14 times. Here we have an amount of 13 times. Then you multiply by the earnings per share. If your earnings per share was wrong, also this one will be wrong. So the earnings per share was 0.63. That was 0.57. So on average, how much is the market price per share? 8.82. 7.4. So good. So now we have the market price per share. This is 8.82, 7.41. And this one, you can also express it in percentage, it's still okay. Let's just express it in percentage. Sorry? 3.85. 0.0 in percentage, 3%. 2.9. 7. Now, who can interpret that for me? Or who can interpret to others? Don't interpret to me. You know, the financial statement analysis is trying to explain now to the shareholders who are not financially literate, who are not accountants. That's the objective of doing the financial statement analysis. And there is no you can tell an accountant, someone who is a doctor, that there is what you call operating profit at EBIT. He'll ask you what are those? Are you together? Yeah, just you want to determine how was the performance? How was the performance? It's like telling someone, the doctor telling you that the patient is improving. He's trying to explain to you. That's what you call interpretation. Or the correction is not good. So now, how can you now explain to a doctor who is a shareholder in this company with no financial literacy when it comes to accounts? Now, the dividend yield increased from 2.97 to 3.85. And therefore, this one is a very intelligent doctor. We'll ask you some questions. What does that mean? What does dividend yield mean? How do you interpret? You can try. How do you interpret? It's very simple. Just look at what you're computing. You're computing the ratio of dividend against the market price per share. So in short, it's try to say that if the market price is 7.41, let me give you 100% or 100 shilling. I want to use this. If you buy one share now at 100 shilling, you will get an equivalent dividend of 2.97%. So that means automatically you know you earn a dividend of how much? You earn a dividend of 2.9 of 100. That's what we call the dividend yield. It shows the proportion of what is recommended to be paid to the shareholders into proportion to the current market price per share. The market price per share in this case is 8.82. That's the current market price per share. But how much are you paying as dividends? You are paying 0.3. What's the proportion of what you are paying to the shareholders into proportion to the market price of every share? So we are giving them 3.85. Good. So now you can copy. Now, as we finish up on this topic, now let's look at advantages. Advantages of ratio analysis. Advantages of ratio analysis. Advantages of ratio analysis. That is what? Ratios are used to determine. Ratios are used to determine. Ratios are used to determine. Ratios are used to determine the ability of the company. Ratios are used to determine the ability of the company. The ability of the company to settle short-term obligation. The ability of the company to settle short-term obligation. To settle short-term obligation when they fall due. The ability of the company to settle short-term liabilities when they fall due, i.e., current ratio, not current, sorry, I mean liquidity ratios, liquidity ratios, liquidity ratios, i.e., liquidity ratios. Number two, ratios helps to determine the efficiency in which the company utilizes its assets. The company utilizes its assets. The company utilizes its assets to generate returns. Yeah, how the company utilizes the assets to generate returns. i.e., which ratio are those that indicates how the company utilizes its assets, the efficiency to which the company utilizes the assets. Which ratios are those? i.e., activity stroke turnover ratio. Activity stroke turnover ratio. Activity stroke turnover ratios. And can you another advice? Now, when you are investing on ratio analysis, don't just know about the ratios, also know the categories, because the examiner can be specific. Yeah, compute any three liquidity ratios using the above information. Any three liquidity ratios. When you start writing earnings per share, okay. Will you be correct or wrong? You'll be very wrong, right? Because liquidity, you need to know which ratios show how liquid the company can be able to pay its short-term obligation. So you need to know all the ratios and then fall under which category. Another one, ratios helps to indicate the magnitude to which the company, which the company has used borrowed funds, the magnitude to which the company has used borrowed fund, the company has used borrowed fund to finance its assets, the magnitude to which the company has used borrowed fund to finance its assets, or investment, to finance its assets, Another one, they helps to determine the value of the company. They helps to determine the value of the company. They help to determine the value of the company. i.e., valuation ratios. Another advantage, they are used to compare the performance. They are used to compare the performance of the company. They are used to compare the performance of the company over a given period of time. Over a given period of time. That is, yeah, it's known as trend analysis. Trend analysis. So for example, what we have done in this question, this is what we call the trend analysis. We are comparing the performance of a given period, the performance of the same company, but of a given period. Also another, they used to compare the performance of the company. They used to compare the performance of the company with that of its competitors. They used to compare the performance of the company with that of its competitors, i.e., how do you call that? i.e., cross-sectional analysis. So those are the some of the advantages of using the ratio analysis. Now let's look at disadvantages. Now, what are some of the disadvantages of using ratio analysis? You see that? Disadvantages. Number one, ratios ignores the effect of the inflation. Ratios ignores the effect of inflation. Ratios ignores the effect of inflation. But does not take into account the inflation effect. Now, for example, if you are computing the gross profit, how do you get the gross profit margin? That should be one of the easiest formulas. Gross profit margin, you take what? Gross profit divided by what? Sales. Yeah. So what does inflation does to the price of product? Okay, do you know what's inflation? Okay, what is inflation? When you know that inflation is too high. Yeah, that's a concept of a systematic increase in prices. Are you together? Yeah. Now, what will happen if the company, for example, let's assume that you are a company. On a good day, you are selling 300 units. Each at, let's work with which product? Which products the prices have increased over time? The price of Mahunga, 2 kg cost how much? Okay, used to cost how much? 100, Yeah, let's work now with another people. For example, let's work with 150 shillings, right? And then after 1 year, so because in this case we are comparing between the two. So how much that means in that case, how much will be the revenue? If you sell 300 packets, on average of 150 shillings. That is very simple. What that? You get 45,000, right? Also in a given year, you sell the same thing, 300. Actually, let's not work with 300. Let's work with 290. But now the inflation has gone up. Now one packet is costing 215, or was costing 215. How much will you recognize as a revenue? Sorry? 350. Now, what has happened to the quantity you are selling? The quantity has gone down. But what about your price? Are you getting it? So, if you compare the performance, what has happened? Actually, the business is not good because the quantity is reducing, but you are showing an increase in sales. But if you ask this shopkeeper whether the economy is good or not, I can tell you, yes, the sales are high in shillings, but also the cost of production also is high. So that means the profitability goes down. But in case they are not computing the gross profit margin, so what will happen? If you just use the sales the way they are, it will show you that the margins are increasing. But in reality, the margins are not increasing. Yeah, therefore, ratios does not take into account the effect of the inflation. Number two, ratios does not take into account the concept of time value of money. The concept of time value of money. The concept of time value of money. Yeah, that will be one of our topic, time value of money. Another one, ratios uses accounting information. Ratios uses accounting information. Ratios use, yeah, using accounting information, which is prone to manipulation. Which is prone to manipulation. Which is prone to manipulation. Yeah, you see, sometimes the organization, actually the management is the one who's responsible for that. But in this case, they want to attract investors. And you see, mostly, the investor will act on the financial information provided. If you want to attract investors, what will you do? Number one, you need to show them that maybe the income is increasing. So what you can do, even for I know that the profitability is not increasing. So you can tell the accountant, pick those books. So that when you're doing the ratio analysis, the investor, the investor relies on the information provided. But in this case, if the information provided in the financial statement was not correct, what will happen? That means you as an investor, you make a decision based on the wrong information. Good. Another one. Ratios uses historical data. Ratios uses historical data, which are then used to predict. 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 Which are used to predict. But actually, most of the accounting information, apart from the budgets, all the other information are historical, something that has already happened. And that's what now you need to do to forecast for the coming year. So, which poses a challenge because when you try to forecast, there is the element of we call the uncertainty. Now, that uncertainty, that means that what you expect and the actual, the reality, what will happen that time, sometime might not tally. Another one. Ratios ignores qualitative aspect. Qualitative aspect. Since it only captures, it ignores the qualitative aspect. Since it only captures quantitative aspect. Since it only captures quantitative. Since it only captures quantitative aspect. Quantitative aspects. For all the computation of ratios, they only capture the numbers. Numbers what we call the quantitative, ignoring the qualitative. What are some of the qualitative elements of a company? Sometimes there is dress code. Also, satisfaction of the employee, goodwill of the company, remuneration, etc. Good. Another one. A ratio analysis does not consider, or ratio analysis does not consider the size of the company. Does not consider the size of the company. Size of company. Does not consider the size of company. So that means you cannot carry out what we call the cross-sectional analysis. When you are comparing your company and another company, which are of different sizes, ratio does not capture that. Another one. In case of a monopolistic company, comparison will not be possible. 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 Yeah, good. So, and that marks the end of our topic as well as the end of the class.